In this video, I want to speak about gold. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect of this market. And by the end of the video, by using the combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here on this pair. Now, starting here from the monthly time frame, what we can see is that we have a market which has just created a very strong impulse to the upside, followed by the start of this correction. Now, in general, after an impulse, if we want to measure the correction, what we have to do is take a Fibonacci from the low to the high of the impulse. And if we do that, we can see how we have a perfect 0.32 and 50% Fibonacci retracements, both lining up exactly at this area, which we did in fact expect the market to test and then to start to potentially reject to the upside. Dropping down on the weekly time frame, what do we have? Now, from a weekly perspective, we can notice how the market so far has been moving in a perfect uptrend, creating a series of higher highs and higher lows, every time going and testing exactly the previous resistance turn support before then rejecting it to the upside. So in a situation like this, we could expect a bit more bullish price action to be developed away from this zone for the market to continue the uptrend that it currently still has. Going down on the daily time frame, what do we see? Now, from a daily perspective, what we can notice is that at the moment the market is still below the previous high. Clearly, we have a bearish trend from a daily perspective, with the market creating a series of lower lows and lower highs. The last move was the creation of a lower high and lower low. So unless the market here will manage to break above this level, the market from a daily perspective will continue to be considered to be in a bearish market. So only if we get a break above this resistance, only at that point, monthly, weekly, and daily would all be aligning in the same direction. So if we do get the break on the retest of this previous resistance turn support, as all the directional timeframes are showing the same direction, there is a good probability of a reject. Now, what this does is it increases the probabilities that if we actually get the break on the retest, we actually get a rejection higher, because this would be a good zone, since it would be a shift from a daily bearish market to a bullish market for institutions to be adding more longs. And at that point, we would have a higher probabilities of this potential move to the upside. So if we do get the break on the retest, how we could be approaching this potential rejection to the upside. Now, as usual, trading is reactive and not predictive. The monthly, weekly, and daily data, those are the best time frames from a directional perspective. However, when it comes to confirmations and entries, the best time frames are the intraday time frames, so 4 hour and lower. Therefore, what we could be doing, potentially also with students, is monitoring price action from an intraday perspective during this move to the downside, waiting for the market to shift from an intraday bearish market as we would have to an intraday bullish market. And if the market would shift from an intraday bearish to bullish market and provide to us one of our valid entries, at that point we could be looking for this potential rejection to the upside for the market to complete this impulse correction and impulse pattern to the upside. And if you enjoyed this free analysis education and update, make sure to drop a like and a comment. It really does support the creation of more free analysis education and updates for all of you, and I will see you in my next breakdown.